Hi, good morning everyone, and thank you so much for joining us here at our FSM Invest Expo 2025. So my name is 𝗲𝘃, I'm part of the research team at iFAST, and today the focus of my presentation will be on our market outlook for the year ahead and how investors should position their portfolios in 2025. Now, I think Joshua has said it on his slides just now, but I'm just going to say it one more time, that 2024 was a year of elections, because you have half of the world's population voting in the elections of more than 70 countries. But none of these elections were as important as the one that took place in the US, because the outcome of the presidential US elections, it has a big impact on everything, from the global economy, financial markets, to geopolitical dynamics. And regardless of how you feel about the outcome, the reality that is confronting us investors right now is that Donald Trump is back, and he has been re-elected with a mandate to make America great again. So, he has been telling people that, the Biden administration has destroyed the American economy, and also that the US economy is the worst economy ever. But I feel that this is a very strange statement to make, because even though America, it has its shortcomings, definitely, but if you look at its economy and its stock market, these two areas, at least, they don't have to be made great again, because the economy and the US stock market, they already are great. In fact, these two areas of America, they are stronger than ever. Okay, let's look at the US economy. Okay, the US economy, it's obviously stronger than ever. It is far from being destroyed. And in fact, it has been outperforming its peers over the years, even before Joe Biden took over. Now, if you just look at the chart on the left, which shows you the size of America's economy relative to the G7 economies. So in 1990, the US was about 40% the size of the G7 economies. Fast forward to today, that percentage has increased to 60%. So it has been outperforming its peers in the developed world. And also during this period, the US has also successfully held off China's challenge to its economy. Now, if you can recall, about a decade ago, I think that there were many analysts who sort of predicted that China would have by now overtaken the US to become the world's largest economy. Has that happened? No, it hasn't. Okay, what has happened instead is that China is now facing huge economic challenges at home, and its economy and its stock market has been lagging behind the US in recent years. Okay, now let us turn our attention to the stock market. I think the US stock market has been doing exceptionally well. I know for those of you who have been investing in the US stock market, I don't think you need me to remind you, because every time when you check your portfolios, you will definitely see the outsized returns that are being generated by your investments in US equities. And also for those of you who were here last year for our Invest Expo, if you can recall, our recommendation was for you guys to invest in digital economy stocks and semiconductors. And if you did, congratulations, well done, because you would have generated quite a lot of returns from our recommendations. So our advice last year was to invest in semiconductors and digital economy. Our advice this year, it remains the same. It is to keep faith in the US and continue investing in sectors that will benefit from structural trends. And this includes sectors like your digital economy and semiconductors. So the re-election of Donald Trump, it does not change anything. Yes, we know he's a tariff man. So, once he's re-elected, next week onwards, when he's officially the president of the United States, you can be sure that he will start, to think about implementing higher tariffs on not just China, but on the whole world. And yes, we also know that he has implemented, he has proposed to implement crackdowns on immigration. So that could potentially result in a tighter labor market in the US and perhaps have an inflationary impact on the economy. So yes, I think these are legitimate concerns. But yet, at the same time, we also believe that the US has several key strengths that will enable it to maintain its global dominance regardless of who the president is. And I think one of the key strengths of the US is actually its capital markets, because the US has by far the world's largest deepest and its most liquid capital markets in the world, which means that the funding landscape in the US is actually very well developed. And businesses in general, that if they need to do their fundraising activities, they have efficient ways of doing it in the US. And there is also plenty of funding available for high-growth startups. And why is this important? It is important because having a well-developed capital market, it is important for innovation. When it comes to innovation, not only do you need good scientific research, you also need a well-developed capital market to turn all these good research into global technology companies. And the US has a very long history of doing that. Do you think it's a coincidence that the largest and the highest quality companies today are predominantly based in the US? Is it also a coincidence that the US is home to the world's largest technology companies? It is not. The robust capital markets and funding landscape in the US has enabled them to consistently produce all these tech success stories. And you look at Europe and the UK, okay? They also have very good universities and institutions that produce excellent scientific research. But at the same time, the capital markets are not as developed as that of the US. And it is because of this that Europe has been lagging behind the US in terms of innovation in recent times. And even if Europe does produce some promising startups occasionally, these startups, they have all been going to the US to do their fundraising activities, because the US in general is a more attractive place for businesses to do their fundraising activities. So this is important because it is a significant advantage that is very difficult for other countries to replicate. It ensures that the US will continue to lead innovation, and it also ensures that the next big thing, the next tech success story, it's more likely to come from the US than from Europe or even China. And on top of that, because the US is likely going to lead innovation, this also means that US companies, they are going to be the key beneficiaries of structural megatrends. Now, if you think about some of the most recent advancements in technology, including AI adoption, if you look at some of the leading AI companies in the market right now, in the market for AI chips, I don't think I need to tell this to everyone, but NVIDIA is the undisputed #1 player in the market for AI chips, and it is a US company. What about the market for AI models and platforms? The dominant companies are again US companies, with big tech companies like Microsoft, Amazon, and Google having a big presence in this market because they have been investing heavily in model buildings, and they have also been, they also own the entire cloud infrastructure of the world. Okay, so big tech companies, they have a big presence in this market. So because US is leading innovation, and also because some of the biggest tech companies are also based in the US, so what this means is that the US, companies in the US, they are going to be the key beneficiaries of future technological advancements. Okay, while we expect the US to maintain its dominance, this does not mean that we expect a smooth sailing journey ahead for the US. We do acknowledge that Trump's re-election has added a huge uncertainty to the outlook of the global economy, especially if the worst of his policies materializes, which includes tariffs on pretty much everything that the US imports, the mass deportation plans that he has proposed during his, election period. So yes, we acknowledge that, all these things, they have added uncertainty to the global economic outlook. But before you start panicking, I just wanted to also remind everyone here that the US is home to a high concentration of high-quality companies. So these are companies that have strong profitability and solid balance sheets. And these are also companies that are dominant in their respective markets, so which means they have strong competitive advantages that will allow them to stay ahead of their competition. So this also means that they are well positioned to absorb any shocks to the global economy. And on top of that, a lot of these US companies, they are MNCs with global business models, which also means that even though they are headquartered in the US, they don't just sell only to the US consumers. They sell to global consumers. which means that their target market is a lot bigger than it seems. Their target market is not the US. Their target market is the whole world. So these companies, they are very well positioned to absorb any potential shocks to the global economy. And on top of that, they are clear beneficiaries of mega trends like AI adoption, which I have highlighted in my previous slide. And what this means for US companies is that their earnings potential, their long-term earnings is tied more to long-term structural trends rather than being tied to short-term fluctuations in economic conditions. So that makes them especially resilient to any adverse economic conditions in the short term. And you also need to do a bit of a relative comparison. Okay? You need to ask yourself, if Trump really does implement his most radical policies, if the US economy and the US stock market does suffer from the worst of Trump's policies, are there any other economies or stock markets out there that can potentially outperform the US? I don't know about you, but I struggle to think of alternatives that can outperform the US, simply because the US economy on its own, it's highly diversified. Okay, you just need to look at this chart over here, okay, which shows you the total amount of international trade for each country as a percentage of their GDP. So it's essentially a measure of how dependent each country is on international trade, and it's also sort of a way to tell how each of these countries will be affected if, let's say, there's going to be an all-out trade war. Okay, the US, as you can see, is actually not highly dependent on international trade. Its economy is highly diversified, and that actually makes it less vulnerable to trade wars and also other potential shocks compared to other countries. Okay? The ones that will likely take the most damage from an all-out trade war is actually countries like Europe, countries like Mexico, countries like Canada. So these countries, they are not only highly exposed to international trade, but they also have jarring trade surpluses with the US, which Donald Trump obviously does not like. So these companies, these countries, they will likely be the primary targets of Trump's policies, and they will likely take the most damage as well. But Europe, on top of just being exposed to international trade, Europe is also facing instability at home and political paralysis as well. And its economy, it has been facing weakness in recent times, and that's also limiting its future prospects. So would I expect Europe to outperform if the US doesn't do well? I would say no. What about China? Okay, if you look at this chart here, China is actually less exposed to international trade as compared to other countries. That's also because its economy is more driven by domestic consumption rather than international trade. So it is actually less exposed to international trade compared to some other countries in this chart over here. But China, at the same time, it faces more, it has serious issues that it is facing at home, because it is facing a confidence crisis at home, and it has been struggling to revive its economy. So again, do you think China can outperform the US? I think, all things considered, I think it's very unlikely that China can outperform the US if the US doesn't do well. So I think my point here is, even if the worst of Trump's policies materializes, even if the US economy and the stock market does suffer some damage in the process, I think there are very few nations out there that are well positioned to outperform the US. Of course, one of the key concerns of investors, especially fixed income investors, so one of their key concerns is actually the widening deficit of the US economy. So this is a legitimate concern, because if the government keeps spending and spending without a corresponding increase in tax revenues, then what they have to do is they will have to keep borrowing money, and that's going to result in higher debt levels that will restrict the government's ability to respond to future economic crises. Okay, so that is the key concern. The simple solution is, of course, to raise taxes and cut spending, but it's not always so straightforward, because no politicians will want to do that. Cutting spending and raising taxes are deeply unpopular with the general public. And no politicians are elected with a mandate to raise taxes and cut spending. If Mr. 𝗪𝘆𝘀 tells us today that he's going to do just that, how many of us are happy? I don't think any one of you will be happy. I won't be happy. I will still pay my taxes, but I won't be happy. And because these are deeply unpopular, politicians, they don't want to confront this problem. So every incoming administration in the US, what they do is they will promise tax cuts, they will promise higher spending. The problem of a widening deficit, oh, that's being left to the next administration to settle. That's not my problem. So that's the problem here. Simple solution, but not so straightforward. So the question then is, if the deficit continues to widen, how big is this an issue for investors? Is that something that we should be particularly concerned about in 2025 at least? Our view on this is that it is currently not an immediate danger to the US economy. And that's simply because of another advantage that the US has, which is the dominance of the US dollar. And there are several areas where the USD is actually pretty dominant, one of which is actually in the area of trade, because the USD accounts for 54% of foreign trade invoices globally. And a lot of it is actually non-US trade, which meaning a lot of it is actually trade that does not directly involve the US. So there's a bit of a network effect over here, because if everyone is using the US dollar to invoice their trades, then naturally the rest of the world, they will want to use US dollar as well. So this network effect, it continuously reinforces the dominance of the US, which makes it very hard for alternative currencies to take the place of the US dollar. In the area of reserves management as well, I think the US dollar is also dominant because governments and central banks across the world, they predominantly hold USD-denominated assets as reserves. But of course, the reality is that in recent years, the US government has started to use the US dollar as a sanctions weapon, which means that central banks across the world, they have started to diversify their reserves away from the USD. So the share of USD assets in central bank reserves has been declining over the years. But the interesting thing is that the central banks, even though they are diversifying away from the US dollar, do you know what they are buying into? It is not another currency. It is not another currency. The thing that central banks are buying into instead of the USD is gold, which means that gold is currently only the real alternative to the USD, not another currency. So there is no other currency out there at this point that is close to displacing the US dollar. The USD is still king. And in the area of investments as well, I think the USD it also reigns supreme, because I think a lot of people has been holding US assets, and understandably so, because the US market is the deepest and the most liquid market in the world. So it's a key source of assets, not just for US investors, but for global investors. So you can see from this chart over here, okay, which shows you the amount of the total value of US securities that are being held by non-US citizens. And I think very clearly, the total amount of foreign holdings in US securities, it has been rising steadily over the years. So why is the dominance of the US dollar relevant to this issue of a widening deficit? Okay, it is important because the global dominance of the US dollar, it ensures consistent demand for the currency. It ensures that investors are still willing to lend to the US government, and that the government should have no issues borrowing in the bond market at this point. So that actually translates into a higher capacity for the US government to take on additional debt. And that provides a significant buffer against any potential fiscal crisis. Okay, we just need to look at Japan. Okay, Japan's debt to GDP at this point, it's even higher than the US by about 2 times. But its currency is nowhere near the dominance of the USD. The Japanese yen is actually number 3 in the world, but yet Japanese government debt is still sustainable at current levels, and a fiscal crisis is still nowhere in sight. What about the US? With a much lower debt to GDP level and with a dominant currency, which gives it a higher capacity to take on more debt, is that, of course, I think it looks sustainable at this point, given all these different factors. Of course, we're not saying that prudent economic management is not important. It is important. Okay, it is important for the US government to engage in prudent economic management. But what we are saying essentially is that US debt levels at this point, it is sustainable, and the point at which US debt becomes unsustainable, that point is still quite some time away. So it is not an immediate danger to the US economy and not something that investors should be particularly fearful about. Okay, I know I have talked a lot about the US equity market, but I just wanted to emphasize one more time that the best stock market to be in for 2025 and beyond is the US. A long-term bet on the US is still your safest bet. Okay, Donald Trump is arguably the most unpredictable president in US history. So there is currently a great deal of uncertainty surrounding what he's going to do. So, to try to analyze what he's going to do and try to analyze the impact of it, and then changing your investment strategy to suit what your analysis is, I think it's a very dangerous and a very short-sighted strategy because there's a great deal of uncertainty surrounding what he's going to do. So what investors should be concerned about is the long-term prospects of the US market. You should be concerned about fundamentals. You should be concerned about company earnings. And don't take my word for it, okay? Don't take my word for it, okay? You just need to look at the historical performance of the S&P 500 across both Democratic and the Republican administrations. And I think very clearly the S&P 500 has performed well under both parties, which also means that politicians do not determine stock market returns. The only thing that ultimately drives the stock market is fundamentals, it's company earnings. And at this point, I think the earnings outlook for US companies is relatively optimistic because, like I've said, it is actually tied to long-term structural trends. So investors are better off by staying invested, particularly in those sectors that benefit from long-term structural trends, such as the digital economy and semiconductors. There will, of course, be drama along the way, but if you want to bet against the US, then we're, of course, more than happy to take the other side of the bet. Okay, outside of the US, okay, there's also another market that we like a lot, and that's Japan. And we see Japan as an attractive structural opportunity. So Japan is currently at a turning point because it's undergoing an economic transformation from deflation to inflation. But it is starting to change because inflation is starting to pick up in Japan, and Japanese companies, they are now more comfortable raising prices, wages in Japan, it is starting to pick up as well. So if all these trends persist, if all these trend continues, then there will be a reset in price and wage expectations, which will provide Japan with a golden opportunity to break free from its deflationary cycle. Because if wages start to go up, then what is going to happen is that consumers, they will be more likely to spend. And businesses, on the other hand, if they see that consumers are now starting to spend, then they will, of course, forecast greater demand for their products in the future. So that will lead them to start investing in future growth using the cash power that they have accumulated on their balance sheets over the years. So this will create a virtuous cycle that will eventually have positive implications for the share prices of and also the earnings of Japanese companies. So that's on the economic front. And I think on the stock market front, there has also been some sort of a transformation because Japan has been making small but steady progress towards becoming more shareholder-friendly by implementing structural reforms that are aimed at promoting capital efficiency and shareholder returns. So these reforms have actually made Japanese companies more accountable to shareholders by making them focus on metrics such as profitability, shareholder returns, instead of things like workplace stability, which in the past used to be one of the key focus for Japanese companies. So one telltale sign that things are starting to change at the stock market level is the fact that activist investing is starting to gather momentum in Japan. Now, activist investors are those people who take a small stake in a company with the intention of making significant changes to the target company, and attempting to unlock hidden value. So in the past, activist investing was frowned upon in Japan because the thinking is that if the management is not doing well, you as the shareholder should be getting behind the management and supporting them so that they can do better. So that was the thinking last time. But now the thinking has shifted a little bit because activist investors are starting to come in. Instead of supporting them, we should put pressure on company management so that they can do better. And this shift is accompanied not just by foreign investors coming in to do activist investing. Domestic investors in Japan, they have been expanding their presence in activist investing as well, including your domestic institutional investors. So I think that's a sign that Japan is at a turning point. And if you do not already have an allocation to Japan, I think it is a market that deserves a core allocation. Okay, I think I'm running out of time. So I will just quickly run through this one last slide, okay, which is our dark horse pick for this year. Okay, if there is one market that can potentially outperform the US, if there's one market that can potentially surprise us all, it is China, but under the right conditions. So what are some of these conditions that need to happen for China to outperform? Okay, in the short term, the government needs to roll out more stimulus measures. Okay, stimulus measures alone will not be able to solve all of China's economic problems, but it will at least prevent a further deterioration in economic conditions. So that's number one. Number two, in order to have a more sustained rally in the Chinese equity market, China needs long-term structural reforms that will help it to restore confidence. Because its problem right now is a confidence crisis. It's a bit like toothpaste. Okay, confidence is like toothpaste. Easy to squeeze out of the tube, but when you decide that you want to put it back in, it's almost impossible. And that's the issue right now. So what they need is long-term structural reforms. I won't go through all of the things that the Chinese government needs to do, but what they need to achieve is that the government needs to show the private sector its long-term commitment to free market economics and also its commitment to greater protection for the private sector. They need to be convinced that the private sector is competing on equal footing with the state-owned companies, which have traditionally been receiving preferential treatment from the government. So if they can do that, confidence will start to return, and this will be a major catalyst for the Chinese equity market. Okay, but one thing that I just wanted to leave everyone here is that China is still a market that we're negative on in the long term, which also means that if you are a long-term investor doing a buy and hold strategy, China is not something that you can buy and hold. Okay? It's not a market where you buy and hold in your portfolio and you expect it to appreciate in the long term. It won't happen. But if you're looking for something that's more shorter term, a short-term tactical bet in your portfolio, I think China is one of those markets that you can consider for your portfolios. Okay? As a summary, I think one sentence summary for my presentation today is, if we can recommend one market for you to invest in 2025 and beyond, it is going to be the US equity market, particularly in sectors such as the digital economy and semiconductors. Okay? And with that, I end my sharing today. Thank you so much for your time.